think at the heart of investing in Australian equities is really a view on Australia as a country. And I think Australia is a great place to invest. We're one of the fastest growing economies in the developed world. We have great institutions. We've got a government which has actually, got a good balance sheet. We have really well-run companies, and you put all that together, you have a market where, returns can be good. There's lots of opportunities. As an investors, you can take a really good long-term view and make good money for your investors. And, that therefore means it's a really good part of any diversified portfolio.
Yeah, so Australian equities have an important role to play from three different elements. So firstly, you get income. Secondly, you get growth. And then thirdly, you get the diversification benefit. On income, Australian equities really benefit from high dividend payout ratios, which translates to attractive dividend yields on stocks. And you also benefit from the Australian franking credits regime. Secondly, on growth, we have some really high quality growth companies in Australia. If you can succeed and grow from nothing in Australia, which is a smaller market, and get those unit economics that work, you're really well placed to scale that exposure or that model offshore. And we've seen that success with the likes of CSL in the healthcare sector, or Xero or WiseTech in software. And then finally, the diversification benefits. In Australia, our market is more weighted to financials, resources, healthcare than, I say, the US, where there's a much bigger tech exposure. So you get those sector exposures, diversifications, and you also get the benefit of geographical diversification, particularly for those businesses which have more exposure into the Asian region than perhaps the US market might offer you. We have one of the largest teams in the market with 19 investment professionals who are very tenured. And I think on average our team has about 20 years of experience. And we've got a range of people who have been with the team for their entire careers, through to people who've come in like myself after having a couple of different careers. And that creates a lot of diversity of thought. But the team culture is really key to how we are able to work together. There's a lot of respect amongst the team. We do our daily team meetings. Everyone feels free to challenge each other in a respectful way, which translates to better outcomes. And at the end of it, we walk out of those meetings and have very good personal relationships as well.
We have a very big, if not the biggest, active Australian equities research and funds management team. We do that very consciously. We want to cover all the opportunities, or at least understand all of the opportunities in the market, and then we've got very dedicated coverage for each analyst that looks at a sector of the market. We value continuity, and to that extent you'll see that the continuity of the team, the tenure of members within the team is high and definitely higher than the average. We definitely think that continuity in coverage, continuity in personnel, and the cultural advantages that brings have stood us in good stead over time.
We're a team that comes with a lot of understanding, both of markets overall and of industries, and that's really critical because markets are very volatile. There's a lot of sort of emotion that comes with investing, and if you've got the experience and you've seen many cycles, you have that sort of understanding of how markets operate and actually step in to take advantage of those disruptions to actually make good investments, and also identify when maybe the markets are getting too frothy and there's too much sort of hubris in the market to step back. And I think that sort of wisdom is really important for investing. The other thing that having that degree of sort of scale of resources and the sort of experience that we have is that it just gives you that insight into specific businesses, and so how they operate, whether they are in a position to sort of solve the challenges that they're facing, or whether you feel perhaps they are too optimistic in terms of their outlook. And so having that sort of granular understanding of not just the industry, but the company and the people running it, I think is really invaluable for our investment process. A really important part of our investment approach is the philosophy we take to investing, and we have that across the teams. The first of say, 3 key principles is being open-minded, so that you want to make sure that you're always considering all the facts that are available to you, and if something changes, you need to be prepared to change your investment view, because it's a very dynamic sort of process. The second feature that we think is really important is critical dialogue, so that you are prepared to have your views tested, because as detailed and as careful as you may be, you may have missed something. And if you have people who've looked at it, not just the industry you're covering, but other industries, and has got a lot of experience, they may pick up on something that you've missed. And having that extra level of sort of due diligence, I think, can really sort of help make our investment more robust. And then the final thing is just being aware of your biases, because we're all human, and we're all prone to sort of having preferred and less preferred companies and people and management, and therefore you need to be really careful that you're not got these sort of entrenched biases in your portfolio. And so we really are very careful about assessing the sorts of companies that we have in our portfolio and making sure we don't have too many biases, too much thematic risk in our portfolio. And I think that allows us to deliver much more consistent performance over time.
The other important part of our investment process is we do act like business owners. So in that, we're very critical of the decisions that the board and management take within the business. So we scrutinise releases they make and investments they make in the business, if they're making them acting just in the short term to boost short-term profits, or they're really making decisions to improve the long-term durability of the earnings and the growth prospects for that business. We take that very serious.
At our core, we are bottom-up stock pickers. We're not economists. We are a style agnostic manager. We don't pigeonhole ourselves as growth or value. We task ourselves with making money in any and every environment. And the way we do that is having a very good fundamental understanding of the businesses that we're investing in. We look to understand the earnings. We look to make sure that we're backing great management teams. And when we get that right, we can identify mispriced opportunities and we can exploit them. And that's what we do.
There's always risks, and when you think about what are the risks to our market and all equity markets, I think the first one is still the economy. And so if we're in a world where rates have to stay higher for longer, that could create issues with growth in the medium term. Costs, so if we're in an economy where whether it's cost of regulation, labour costs, they continue to squeeze higher and companies aren't able to sort of manage that can impact on margin. And then you have issues such as China. There's structural challenges, and we're very mindful and we watch that very carefully. And then finally, there's geopolitical risks, which hard to dimension, but again, we have to be aware of. Put all that together, you can say, well, that's a lot of risk. But you should always remember that the market prices in these risks, and often it's these risks that create the opportunities, because the market puts far too much emphasis on those near-term risks and forgets about the sort of longer-term opportunity.
When I think about risk management, I think about a couple of different things. So firstly, I think ensuring you've got the tools in place to understand what risk is being taken. And particularly if you're delivering a core strategy, as we do, you want to make sure that you do test the portfolio to ensure it's consistent with core. It's not going to be drift stylistically to value or to growth. So that's one aspect, is the tools and understanding the risk. The second aspect is really around then understanding behavioural risks. As a stock analyst, you often get asked, how do you stop yourself from falling in love with companies? I prefer to think about it a little bit differently. I think that every analyst I've ever known typically has one stock which they do fall in love with or have some blind spots on. Why try to change your behaviours to ensure that doesn't happen? Why not be aware that this is a risk and then put the guardrails in place to ensure that other people are helping you to address those risks?
For us, this comes down to being daily, weekly task driven. There's nothing we find overly special in what we do, but just being consistent in everything that we do. So we continually go and meet our investee companies. We want to better understand their future strategies and the future opportunities they have for growth in their businesses. As an AFL fan, this is, not similar to sport. We have quarter time or off seasons. We have to be on, every day of the week, and, we continue to apply ourselves and learn. So we continue to travel. We continue to, meet with, executives in the businesses that we operate, and we always have an ear open for new investment opportunities to prosecute and potentially improve the quality of our portfolios.
Our priority is to continue to deliver for our investors, and that means consistent investment returns. And that's something we've been doing for 20 years, and it's been built on a process which is identifying well-run companies that are going to continue to surprise the market on the upside. And they can be large, small, value growth. We're looking across the market, and it's continuing to stick to that process that's worked for those 20 years and ensuring that we keep going and we keep, very disciplined, and we sustain that, because if we do that, we can deliver the sort of returns that we've seen over the last 20 years and continue to do that for many years to come.